Welcome again to our second portfolio manager panel, and this panel is focused on our sectors. These sectors affect some of the biggest parts of our life, which are real estate, healthcare, and FinTech. So I'm actually very excited to hear some of the answers here. I want to introduce our panelist, Jeff Kolitch, to my right. Jeff manages the Barron Real Estate Fund, the Barron Real Estate Income Fund, and notably both of these funds have Morningstar's highest 5-star rating. Neal Kaufman on the right manages our Barron Healthcare Fund, and Josh Saltman manages our Barron FinTech Fund. If there's any sectors in the market that touch us more, I think these are three that each of us interact with every single day. I'm proud to note that every single one of the funds that these gentlemen manage on the stage have outperformed their indices since their inception, so congratulations on your performance. Again, my name's Frank Majorano. I head up the Registered Investment Advisor Group at Barron, the Family Office Group, and the bank trust business for Barron Capital. We only have about 30 minutes. As you saw, the last panel went very quickly. So I'm just going to have our portfolio managers give a little bit of opening comments, and then we'll go right into questions from the audience. So Jeff, if I could ask you to maybe just take two minutes to kick things off, talk a little bit about the investment themes that you're prioritizing, and maybe just give just a quick differentiation because you have two funds, so we'll know which a little bit about the two funds.
Great. Thanks, Frank, and great to be back, everyone. Can't see anything out there with these bright lights, which maybe is best, I'm not sure, but great to see everyone. Let me just take a couple minutes, as you suggested. Our number one message for everyone in the audience today is that we're optimistic about the prospects for real estate. We think there's a compelling case to include real estate as part of a well-diversified portfolio. That's both a long-term view and a near to medium-term view. The long-term view is one where what we have set up right now is if we construct our portfolios correctly, we think we can achieve some inflation protection characteristics, diversification benefits, and now that real estate's repriced for a higher cost of capital, we have the three pillars of growth, yield, and hopefully an improvement in valuation. So we like the long-term setup. But what we have in front of us right now over the next 2 to 3 years is more of a tactical opportunity that our team's quite optimistic about. And that is that we believe the dark clouds that have been hovering over real estate are starting to lift. And when you layer on that rates will begin to come down a bit, and I know that's topical and we can talk about that, but when you have rates coming down a bit and you have real estate starting from a very good place where demand's exceeding supply and you have attractive valuations, our team likes to set up for real estate over the next 2 to 3 years. If you concur with that view, then the question is, as you work your way down the decision tree, okay, maybe you made a compelling case for real estate. Should we go public or private? It's not always an either or. They're often complementary, but right now we do think there's a compelling case for public, as much of public is discounted relative to the private market, and you have liquidity and transparency advantages. If you agree with that, then you go, do you go active or passive? Whatever you do, don't go passive. Passive, for real estate at least, has a mix of both the good and the bad, or several categories or regions or balance sheets that are going to be impaired over the next several years. So that gets you to active. Quickly to answer Frank's comment, or to respond to it, we manage 2 real estate funds. The Barron Real Estate Strategy, we're about to anniversary 15 years. This is not a typical real estate strategy. It's a real estate related strategy. What that means is we advocate a broader, more all-encompassing approach. We invest in REITs, C-Corps, operating companies, commercial, residential. It's more of an equity-like, growth-oriented approach to investing in real estate. And the strategies perform well over a long period of time. Just one promotional comment, because I looked this morning, I was happy to see, because we've been grinding to improve our 3-year trailing, but as of this morning, it's the number 1 ranked fund over a trailing 3-year, 5-year, 10-year, and soon to be 15-year. And that's a big shout out to my team. Hopefully you're all in the audience. I can't see anyone, but Dave Kirschenbaum, George Tarras, Dave Burke, and Dave Barron. We manage a complementary strategy, which is the Barron Real Estate Income Strategy, which is a more traditional real estate strategy. Dividend yield is the priority prioritization or income. It's highly complementary to the other. We've been managing that strategy for 7 years. It's doubled the REIT index and also performed quite well. Last comment I'll make, and then I'll pass it to my colleagues. There's a lot we like right now in real estate. We're happy to touch on any of this in Q&A. Everything we do is bottom up, and then we step back and try to see the forest through the trees, and we bucket our investments in 6 investment themes. And we're identifying opportunities in all of them. We're identifying opportunities in REITs, in the for-sale housing market, in travel-related real estate, in commercial real estate service companies, in real estate alternative asset managers, and also the intersection of technology and real estate, or what's called prop tech. So we like a lot, we're bullish, happy to take questions in a bit.
Perfect. Neal, I'm going to ask, in light of the recent election, there's just was a lot of talk about healthcare, and can you talk about some of the themes that you're focused on right now?
Sure, thanks, Frank. So healthcare has been underperforming the other areas of the market for the past few years. We went through a period during COVID when healthcare was booming. There was a massive amount of investment into the sector, and there's been sort of an unwind over the past few years, and various sub-industries within healthcare have faced different types of headwinds. But we're now at a point where the sector is improving. Some of these headwinds are fading. There's still some, obviously, regulatory and political uncertainty that is facing the sector, but we think that the fundamentals, the long-term secular growth drivers for healthcare are still in place. Aging of the population, new treatments for diseases, people are living longer, spending more on their healthcare. These are all positive long-term drivers for healthcare. So where are we focused? We're focused on, I'll just talk about 4 themes that we're focused on in healthcare right now. Robotic surgery is one. So Intuitive Surgical, they're the market leader in robotic surgery with an installed base of roughly 9,500 systems around the world. They're in the early stages of a new product cycle with the launch of their DV5 system, which has 10,000 times the computing power of their prior generation. They're incorporating AI into the system. It incorporates haptic feedback for the surgeon to be able to feel what they're doing. And it has 3D vision incorporated into it. It's a really cool technology, and they're just rolling it out in the early stages now. We think that robotic surgery is under-penetrated in terms of its total available market, and so there's a long runway for growth for Intuitive. Stryker is another medical device company that is involved in robotic surgery through its Mako surgical robotic system for hip and knee implants. And then in addition to robotic surgery, we're focused on companies that are treating irregular heart rhythm. So AFib is a condition that I'm sure most of you are aware of. There's a new technology called pulse field ablation, which uses electrical pulses to treat through an ablation procedure to treat the damaged areas of the heart that are causing the irregular heart rhythm. This pulse field ablation technology is really taking the market by storm. Boston Scientific is the market leader in that technology, and they're growing very rapidly as a result. The third area or theme in healthcare that we're focused on is AI. So we have an investment in a company that is using AI for diagnostic imaging. The company's name is RadNet. They're the market leader in, they operate diagnostic imaging centers in various geographic territories within the US. If you think about what they're doing at these imaging centers, is just think about MRI, CT, X-ray, ultrasound. Their AI algorithm can detect cancer earlier than a human radiologist can, and so they're incorporating their AI algorithm into their diagnostic imaging centers, and they just recently announced a partnership with GE Healthcare where they're incorporating some of their technology into the GE Healthcare machines. So that's another theme of ours. And then a fourth area that we're focused on is innovative therapeutic companies. So there's a category called cellular therapy for multiple myeloma. This is the idea of taking a patient with multiple myeloma, taking their white blood cells and re-engineering them so that they're able to identify the cancer. They're reinfused with the re-engineered cells that can identify the cancer and attack it and treat the patient to the point where we're seeing very effective rates of remission in multiple myeloma. So we have an investment in a company called Arcellx, which has a really effective treatment, just as effective as the current treatments that are available on the market today, plus is potentially safer. So those are some of our focus areas and themes that we're participating in.
Perfect. So Josh, I know that you focus on strong moats and companies with long growth runways, so maybe kind of translate that into the themes that you're focused on as well.
Sure. So I've been managing the Barron FinTech Fund for almost 5 years now. The FinTech Fund is a sector fund that invests at the intersection of financial services and technology, where we see a lot of innovation taking place and where we see a lot of very high quality business models. Our overarching view, and this probably applies to other sectors as well, is that technology is transforming all industries, including financial services, and that creates winners and losers. So we try to invest in the financial companies that are winning from their use of technology, as well as technology companies that are enabling financial institutions to digitize and modernize. Financial services is the second largest sector in the US market, just behind IT services. But most of the financial sector is comprised of banks and insurance companies. We ignore most of them because they're slow growing and undifferentiated. And instead, we invest in the faster growing companies with strong competitive advantages and outstanding management teams that we think can compound capital for a long period of time. So what kind of companies are those? Well, there are a lot of wide moat sectors, companies in the FinTech sector, and I'll just talk about a handful of them. One big category that we like to invest in are benchmark businesses. These are companies that provide ratings or rankings that lead to better financial decision making over time, better lending activity, better capital markets activity. So these are index providers like MSCI and S&P Global that provide the benchmarks against which funds like ours are ranked. We also invest in rating agencies like Moody's and S&P that rate corporate debt and sovereign debt that helps inform investment making decisions. Morningstar provides mutual fund ratings. These are all holdings in our companies. These are benchmark businesses that enable financial activity to take place. Second broad category that we invest in are network businesses that enjoy network effects. So a classic example of that would be payment networks like Visa and MasterCard that are connecting consumers, merchants, and banks to enable payments to take place electronically. Financial exchanges, CME, TradeWeb, New York Stock Exchange, these are connecting buyers and sellers of securities. These are great entrenched businesses that are very difficult to dislodge. And then third are platform companies. These are typically software businesses that enable their business clients to operate. So these are businesses that facilitate payment transactions, keep track of bank ledgers and accounts. We own a company called Guidewire that manages all the insurance policies and claims for a good number of insurance companies. E-commerce enablers, Shopify, Mercado Libre, they operate marketplaces that connect buyers and sellers for e-commerce, and then they monetize through payments or lending. These are platform businesses that are deeply entrenched in their customers' workflows. They're used every day. They provide valuable services to their customers with high switching costs and therefore enjoy strong pricing power. They're often monopolies or oligopolies. They generate high returns on invested capital with strong growth prospects. They're a big part of my portfolio, and they've generated really strong share price returns over time.
Perfect. All right, so we're going to go to audience questions. If I could see the mic runners, just raise your hand high, and we will go. We have one right over here.
Hi, good morning. Neal, I have a question for you. Given the potential change in the leadership of the healthcare environment, if you will, maybe getting rid of things like the FDA and some other organizations, how do you think that will impact the future growth of new drugs?
Sure. So, first, we don't know whether or not RFK is going to be confirmed by the Senate. So that's still, there's still uncertainty about that. But if we assume that he is, I'm not sure that he intends to get rid of the FDA. I think there could be changes at the FDA to speed drug development, which in the short term could be a positive. It could lower the cost to develop a drug, to bring it to market. Longer term, there might be some issues with that because it could ultimately lead to more competition, which could lead to lower pricing. But putting him in, at the head of HHS, which has a budget of $1.7 trillion and includes all these different agencies, not just FDA, but CDC, which oversees vaccine policy, NIH, which provides funding to life sciences companies that depend on academic lab clinical research. There could be modifications and changes in policy that will create winners and losers. Right now, there's so much uncertainty about what the ultimate policies will be that people in the market, investors, are just selling stocks broadly, and there's a dislocation in stock prices that's occurring. This likely will continue to play out over the coming weeks until there's a little bit more certainty. I think it's hard to analyze at this point in time, not knowing exactly how this is going to play out. So I see there's potential for winners and losers, and we're processing it right now. It was just announced yesterday, so we'll have to see how this plays out.
All right, next question.
Hi, this question's for Jeff. The first part of it got answered. I was curious, about your Brookfield Corp position in the real estate fund, but now that you mentioned your 6 categories with the alternatives, it makes more sense. I know that the Barron family has owned, or the family of funds, I should say, has owned Brookfield for a while, and then I just want to hear your inclusion of it in the fund with the split of the businesses last year, why Brookfield Corp, how you see that, like how much with the, because you're getting a lot of exposure other than real estate. I just was curious to pick your brain on that.
Sure. So Brookfield Corporation, we actually first purchased Brookfield when we launched the fund 15 years ago. If you go back, I'm not suggesting anyone does this, but if you look at our first quarter shareholder letter in 2010, it was our #1 position then. And if you were to look real time right now, it's, I think, our 5th or 6th largest position. So we've owned it over this entire period of time. Brookfield is one of the largest commercial real estate landlords and operators in the world. It's not a pure play real estate company, but this speaks to our strategy. It's a real estate related company, but if you want access to across every sector of real estate and every geographic market and where flows are headed in a large way for real estate, Brookfield certainly checks the box. That would be comment 1. We're more optimistic about Brookfield today than we ever have been. And the reason is that more and more capital is being redirected, and Josh, you know this very well, into alternative assets. And Brookfield is unquestionably one of the long-term winners, as they have a global platform, an operating platform, and an amazing investment track record. We just attended their investor day. George did back in September, I believe. The stock today is in the mid to high 50s, and the management team, who's very understated and very credible, laid out a path where in the next 4 to 5 years, they see the stock going to $176 a share versus 50s today. They have a history of exceeding expectations, and so we're optimistic about it. As the dark clouds over real estate, by the way, begin to lift, which has been weighing on the share price a bit, we think the stock is set up very well over the next several years.
Next question, over here.
Hi, good morning. Another question for Jeff. On the data centers and digital infrastructure side of things, with everyone not being able to get the words AI out of their head and the power demands for those, I'd just be interested to hear, are you guys comfortable with your current investment levels? Do you see that growing, and just kind of where you see that going forward?
Question on data centers. We've never been more optimistic about the backdrop for data centers. Now, I'm sure I'm not the first one to convey that view, that every day you can read about what's happening on the data center sphere. And historically, it has been quite cyclical. But here's the setup right now. It's by far the best setup that we've seen in my 20 years at Barron Capital, but our history of investing in data centers precedes my 20 years. It really goes back to the inception of the firm. The reason we're so constructive on the setup is, number one, the demand vectors are expanding. So you have cloud adoption, you have people spending more time online, you have companies outsourcing their data center needs, and then of course, as you know, the AI theme is a new demand vector. So the demand vectors are very powerful, very enduring, and they're going to persist for quite some time. Against that backdrop is the supply side, where on the supply side, it's very much contained. One, and this is a broad comment for real estate, what really underpins our optimism for real estate, it all comes down to simple economics of demand relative to supply. On the supply side, there's been very little new construction activity, not only for data centers, but across every category for the last 3, 4, 5 years, and there's very little coming the next 3, 4 years. Why? Because it isn't economical to build. The appreciation in land prices, labor costs, material prices makes it very challenging. So we have very little new supply against a demand vector. You have rents that are going to continue to increase for a very long time. Importantly, for any new development that is occurring, and there is development that's occurring as the large Mag 7 companies, Microsoft, Amazon, Google, and others, are all saying to the companies we own, Digital Realty Trust, and Equinix, and an Asia-based data center company we know, GDS, you go build it for us. But what's happening is the development risk is mitigated right now because they're saying, you go build it and we're going to take down all the space. And so we have very little development risk, strong demand, strong rental pricing, and oh, by the way, in our view, public data center companies, even though they've performed quite well, are still trading at discounts to the private market, and we have some very recent data marks for that suggest that we're once again going to get growth, yield, and an appreciation in the multiple. So we like it.
Jennifer?
Yes, hi. This question is for Neal. Can you elaborate on the GLP-1 space and Eli Lilly, Novo Nordisk, and how you see things shaking over the next 2 to 3 years?
Sure. We continue to believe this is going to be a very large market. So there are something like 100 million people in the US who are overweight or obese. There's another 30 to 40 million people with type 2 diabetes. So the overall market opportunity in the US alone is something like 130 to 140 million people for GLP-1 medicines. And so we're still in the early stages of adoption in this market. So there's something like 6 or 7 million people today in the US on GLP-1 medicine. So we're really just getting started. To be a real player in this market, it requires significant capital, significant investment in CapEx. Eli Lilly and Novo Nordisk are, the incumbents. In our view, they're likely to maintain their leadership position. They have substantial pipelines of new medicines coming behind what they're already offering on the market today. They've made substantial investments in CapEx. Eli Lilly, I think, has said $18 billion over the past 3 years. They're going to continue to invest billions of dollars, and they have interesting new medicines ahead of them, including an oral GLP-1 medicine that has shown promising data so far that should be available in the market in a few years. So we think that both Lilly and Novo Nordisk will remain the leaders. There are many companies in earlier stages of development working on new medicines, and so there could be new entrants into the market, but to be a real participant, you need capital. So many of these smaller companies could be acquisition candidates depending on how good their data is, and we'll see. But we're still very bullish on the overall market opportunity, and we think Lilly and Novo will remain the leaders.
Josh, I wanted to ask a question came into me. on email last night on electronic payments and digitization. So I don't know if you really combine those at all, but maybe some of the players in electronic payments, what do you see for the next 3 to 5 years, and what's happening in digitization with kind of the banks and manual processes and things like that. So can you cover that?
Sure. So the electronification of payments has been a trend that's been ongoing for decades now. It's happening globally. In developed markets like the US, we're further along in that penetration curve. COVID was an accelerant to that curve. As more people sought to transact online, to tap and pay using their phone or using their card. So further along in developed markets, but there's still tremendous growth in developing countries around the world, emerging markets. So this is a great theme that we're invested in to take advantage of digitization of payments globally. One thing to note is that these businesses are tied to nominal consumption growth. So companies like Visa and MasterCard, as more volumes run across their rails, they earn a small take rate on that, and they earn more revenue. So as inflation goes up or stays high, that drives more consumption, more spending, is very favorable to these businesses. So they are inflation protected in that fashion.
Perfect. Next question. Back left.
Thank you. This question is for Jeff. So as far as interest rates and the shape of the yield curve, how do you think about that in the context of real estate, what you own, and maybe specific subsectors within real estate? I guess where I'm coming from this at is, I think a lot of people believe that yes, short-term interest rates will come down, but there may be a case where longer-term rates stay where they are or move up over time for lots of different reasons. So any thoughts on that?
So interest rates certainly are topical and absolutely relevant to real estate. To be clear, we don't predict interest rates at Barron Capital, let alone other macroeconomic considerations. Now, we don't have our head in the sand as it relates to interest rates. Of course, we need to consider it and think about it. And intellectually, our team, talks through it and has views, but we don't let that dictate ultimately what we're going to do. But what we do think about is our businesses and connecting it to interest rates. I will say, for whatever it's worth, just because it's an intellectual interest, my own personal view is that we are going to have higher rates than we had over the last 10 to 15 years. Many people, perhaps a few in the audience, don't realize that what we had coming out of the global financial crisis up until the pandemic, and certainly the first couple of years of the pandemic, is just not normal. A 10-year treasury in and around 4.5% is the long-term average if you look over the last 50 to 60 years. What we need is, and there's actually an argument for rates to be structurally higher. I don't want to get into political discussions, but conversations about immigration and deglobalization and a whole host, and there's competition for yield, et cetera, would suggest that rates are going to be up at this level. That's okay for real estate. What we need for real estate is rates to stabilize a bit and credit spreads to come in, and then we'll be able to bring buyers and sellers together and figure out how to move forward with the business. But make no mistake about it, if we settle in where we are right now, albeit while we would like lower rates, of course, for real estate is a tailwind. It improves valuations, it brings buyers and sellers together, it lowers debt refinancing costs, it encourages tenants to have more confidence to grow their businesses. So on the margin, we prefer it lower. But if we just stabilize in and around where we are right now, real estate can do very well here. In terms of how we position our portfolio, what we have in mind, if we do have higher rates, we try to focus on companies that can reprice on a more regular basis for a higher cost of capital. And if they have rents that are below market, if they reprice on a more regular basis as the rents come up or the leases expire, they can increase rents to somewhat offset the higher rates. So think short lease duration real estate. It could be apartment REITs such as Equity Residential or Avalon Bay that we own. It could be single family rental REITs that we own that also reprice once a year, such as Invitation Homes or American Homes. What reprices every day? Hotels. Frank can go into a hotel today and charge him, $250, and I can go in tomorrow, charge him much more than that, he's expensive, and charge me $50 more tomorrow. That's a great inflation hedge for higher rates. So it's a heavy topic, it's a big topic, but we're comfortable with where rates are right now and how our funds can perform. Sorry.
Perfect. Thank you so much. Thank you for listening to this panel. Thank you to our portfolio managers. Again, BaronCapitalGroup.com, or contact myself or your Baron representative. Thank you again.